Netflix is set to report results today, and the storyline heading into this set of earnings feels different from where the company was a couple of years ago. Back then, Netflix was having a hard time pleasing investors as its subscriber growth had hit a wall. Since then, the company has found itself back on track thanks to things like cracking down on password sharing or introducing an advertising tier. Those moves, among others, have helped improve the subscriber story. At the same time, the industry has also shifted its thinking on subscribers as a benchmark for strong business performance. Other players, including Disney, for example, have been under pressure to make their streaming operations profitable. The realization that growth without losing money would be hard for everyone left investors reassessing and perhaps better respecting Netflix, which has seen its stock climb from around $200 a share going back a couple of years ago to the current level north of $600. For more on the Netflix story, we're joined by Jamie Lumley, senior analyst with Third Bridge. Jamie, thanks very much for joining us. What is the mood around Netflix today? Definitely seems much more improved than it was a couple of years ago.
As you highlighted, the story is completely different from 2 years ago when Netflix had back-to-back quarters of subscriber losses. This time around, Netflix is coming off of a blockbuster quarter to end 2023, adding 13.1 million subscribers, really putting the business in a strong position when the rest of the streaming landscape is facing a lot of challenges. This time around, as we look at the first quarter of this year, Netflix is reporting before its competitors, and it really has the opportunity to run up the score versus the other players, as there's still challenges for players like Warner Brothers Discovery and Paramount and Disney trying to get profitability or close to profitability in the near future for their streaming business. Netflix is the opportunity here to not just have double-digit operating margins north of 20%, really try to show that in a more stable environment after the strikes last year, it's still able to deliver strong growth numbers on the subscriber front, bring great content to people, and really be a strong business in this environment where they are the leader in the space.
And so does it then, based on all of that, justify a higher valuation? I guess the sort of the short-term biggest question is when stocks have a big run, even if their business is looking well-positioned versus some of their peers, has a stock gone too far too fast? What's your perspective?
Well, when we think about where Netflix is today, there are a couple of key areas that investors are going to have their eyes on in this earnings report. Certainly, people want to know, are the numbers from the end of last year sustainable in terms of overall subscriber growth, but also just understand where that growth is coming from and how much room there is left to run in that sense. A couple of the key initiatives that Netflix has had, the crackdown on ad sharing, the launch of the ad-supported tier in the last year and change, these are areas where there has been growth, but people wonder, how long is that tail? If we think back to the crackdown on password sharing, Netflix announced at the launch of the initiative that there were potentially 100 million households that were sharing passwords. At this point, we saw over 20 million subscribers added last year. We wonder, okay, what is the penetration of that 100 million number? How far can they run? What we've been hearing from our experts here at Third Bridge is that a long-term goal of about 50% conversion of those 100 million households is feasible. So if we see the numbers today and Netflix is able to continue to have growth in what's historically a relatively weaker quarter for them, that could be a positive sign that there is still room to run for the subscriber numbers, and then we turn our eyes towards profitability. As we've said, last year was a bit of an abnormality in looking at just the CapEx priorities from Netflix, the spend they were having on content or lack thereof. People want to see what are the current operating margins, and is that going to be what the sustained normal is for this business going forward?
So we are in a period of disruption within the media landscape. That is also true, as you know, here in Canada, Jamie. And I think a lot of people are very curious about where things go from here, outside of companies just making sure they've got their house in order. The subject of consolidation constantly comes up. Do you see some M&A activity? We've already seen some things playing out in the United States, obviously, in recent weeks. But do you see more of that happening? And how does Netflix fit into an environment where there's a lot of wheeling and dealing?
So when we think about the overall landscape, it does definitely seem that there is some consolidation on the horizon. It's been well reported about the deals which potentially might be happening with Paramount, what the future is for that business. Comcast has talked about, Warner Brothers Discovery has talked about whether or not they're gearing up their balance sheet for acquisitions. The landscape could certainly shift as we get to this point where the focus in streaming has been a shift away from just growth at all costs to actually, okay, can we make this a healthy business where investors see profitability and can gain confidence in where these companies are going? So right now, the big question facing the industry is for the players which aren't a Netflix, which don't have over 200 million subscribers. What sort of scale is actually necessary to turn these businesses profitable? And at what point does it make sense to either consolidate or cut your losses? For Paramount, they have over 60 million subscribers, but they're still losing pretty significant amount of money on a quarterly basis. So for them, if they think about what their future is, whether that makes sense to consolidate with another player, whether streaming is something they can exit, these are the tough questions facing some of the players out there right now. When we turn to Netflix, they're in a very enviable position. They are profitable, they have the largest base, they're able to work on some of these new initiatives like the ad-supported tier, or also build out their gaming arm to potentially have a new monetization piece. So they're able to look beyond just the scale question to think about, okay, we have these existing relationships, we have this scale, how do we better monetize our IP? How do we really create a flywheel so that it's a multifaceted and diverse business? Those are the things that Netflix are thinking about right now.